In the dynamic world of economics, few indicators are as crucial as GDP, or gross domestic product, which measures the total value of goods and services produced in a country. When GDP growth reaches 3%, it signals a robust economy. Conversely, when GDP hovers around 1%, as we may see in the upcoming Q3 estimates, it's a warning sign that economic growth is sluggish. While a 1% GDP doesn't indicate a recession, it does signal rising unemployment, likely increased by 1 to 1.5%. This occurs because the economy isn't generating enough jobs to keep pace with the labor demand. Hi, I'm Shemeika Fox, your Santa Cruz real estate expert and your personalized real estate concierge, and I wanted to share with you a recap of one of my favorite economists, Dr. Elliot Eisenberg. Understanding the nuances of real GDP versus nominal GDP is crucial in this context. Nominal GDP reflects prices at current levels, whereas real GDP adjusts for inflation, providing a clearer picture of the economy's actual output. Inflation, the increase in prices over time, is typically measured annually and is favored by economists when it stays between 2% and 3%. This moderate inflation encourages spending and economic growth. However, when prices fall, leading to deflation, consumers tend to hold off on purchases, expecting prices to drop further. This pattern is currently threatening China's economy and can trap a nation in a deflationary spiral for years, making recovery challenging. In the U.S., certain sectors are showing deflationary trends, such as the sharp decrease in car and electronic prices. However, housing is a different story. Unlike easily scalable goods like milk or eggs, housing development is complex, involving permits, land acquisition, and often bureaucratic hurdles. Housing has historically been an excellent hedge against inflation because despite rising prices, building new homes isn't as quick or as easy as producing other goods. This drives competition among buyers, pushing prices higher. One crucial factor in gauging housing market dynamics is the absorption rate, or the months of inventory available. When the market has fewer than 3 months of inventory, prices typically rise sharply. On the other hand, when inventory exceeds 7 months, price appreciation slows, and with over 9 months of inventory, prices begin to fall. Nationally, the U.S. has 4 months of housing inventory, but in Santa Cruz, inventory is as low as 2.9 months, signaling continued price pressure in that region. Interest rates are another critical piece of the economic puzzle. As the Federal Reserve prepares to cut rates at its September meeting, much of this action has already been baked in by the market. Mortgage rates have already dropped by 80 basis points in anticipation of rate cuts through December. However, unless the Fed surprises with deeper cuts, mortgage rates are expected to remain stable following their September decision. A rise in unemployment could lead to further rate reductions as the Fed seeks to stave off a recession. Interest rates, particularly the 10-year Treasury yield, heavily influenced the 30-year mortgage rates. Though not a daily concern for most, these rates profoundly impact the housing market and overall economic sentiment. In Santa Cruz and the Bay Area, the housing market is closely tied to the stock market due to the influence of Silicon Valley. Santa Clara County's median sales price recently hit $2 million, making it increasingly difficult for out-of-state buyers to break into the market. Several factors such as the stock market performance, income growth, inflation, and interest rates all contribute to this housing market complexity. Additionally, infrastructure changes such as wider roads can also affect housing prices. Easier commutes often make people more willing to live further from urban centers, increasing the value of homes in more remote areas. Despite fluctuations, the current level of housing inventory and demand remains strong, and the sector is expected to pull the rest of the economy out of the doldrums. While the last 2 years have been tough for the housing market, it has weathered the worst, and signs indicate that it will lead the economy out of any downturn. And unlike 2008-2009, homeowners today have more equity in their properties, preventing a repeat of the housing collapse of that era. Even if a recession does come, interest rates will likely fall, boosting housing demand and market recovery. The housing sector, having survived the storm, now stands ready to help the broader economy bounce back more quickly. Thanks for tuning in. I'm Shemeika Fox, your Santa Cruz real estate expert, and as always, I'm here to help. Don't forget to hit that like and subscribe button. See you next time.